morning. Let me first try and get your sense on the latest set of earnings that have come through with regard to Q3. Talk to us about if anything is standing out for you, anything in terms of a thesis which may have shifted or changed given the Q3 numbers, or it's largely status quo.
No, we've been saying discussing in our previous interaction that we have been very positive on the earnings outlook, and that is what has happened. In last 2 quarters, sequentially the earnings have been better. So by and large, earnings have been in line with the expectations, and even especially the mid and small cap space, I think earnings have been very good. And nothing changes from our perspective. We think this momentum will continue. Of course, a lot of uncertainty which was there because of the US trade deal, the tariff situation now gets resolved, and that kind of helps corporates build back the momentum, especially in and around the export-oriented stories, and which is largely the mid and small cap space. So you will see that playing out. But generally speaking, earnings season has been good. There will always be some companies which will be disappointing, and some companies will be kind of surprising on the towards. But by and large, the trajectory and the direction has been very.
Right. Quite interesting. So, Vikas, it's been quite the ride for the markets ever since budget day, and now with the deal getting sealed with the US. What's the way forward? Do you think 2026 will turn out to be better in terms of pure Nifty returns also, as opposed to what the past year was?
I think I've said in our previous discussion that 2026 would be a better year than 2025. For the simple reason, if you see, we started 2025 with a lot of sort of negativity or noise, or the negative news, starting from Pahalgam to Operation Sindoor to tariff, and then a lot of geopolitical situation. When all these things were happening, India was going through a significant monetary stimulus as well as the fiscal stimulus, and that was obviously working very well at the economic level. There was uncertainty around a little bit on the export due to tariffs, which also has got lifted. Also in this crisis, what India has been able to do is FTAs, long pending FTAs with the other countries, likes of EU and New Zealand and other parts of the world. So today we are sitting on a situation where you have good monetary and economic stimulus, and all the broader uncertainties are behind. There will always be uncertainty in the market, something or other. There's no doubt on that, but broadly, there's no much uncertainty around the on the growth. And as more and more people get comfortable around this environment, meanwhile in this period, the valuations have come down, a lot of froth which has got kind of cleared. So you will see, markets doing well. Now, how much it does well, it all depends a lot more on the liquidity, which I think should get better this year, especially from the foreign investor perspective. So I am quite optimistic about the market in 2026.
Because what really took a lag and backseat all through last year was the mid and small cap performance. You think that will get undone? And will they meaningfully perform now?
It always happens that, once the recovery happens, it's always led by the large caps, and the mid and small cap follows through. And it happened in 2021, similar way, 2022 in similar way, post-Ukraine war crisis. I think similar it will happen this way as well. We all know that mid and small cap tends to fall faster, and they also tend to rise faster. Because of, again, sheer nature of the whole, they tend to accelerate. The volatility in the earning with the change in the macro environment generally tends to be far more pronounced than in any large cap or large company. And that happens in the share prices as well. So I'm quite optimistic that this environment is going to be good for mid and small cap. Now, whether it really meaningfully picks up in 2 months, 3 months, 6 months, I don't know. But directionally, we are finding interesting ideas. Risk reward looks very good.
Because your investment style has always been, selecting quality growth at reasonable prices. While growth sure is visible, where do you find reasonable prices in this market?
Looking at the broad, indices cannot be the right answer. You have to, look at the individual stocks specific, and you have to see in the context of the growth, potential growth, right? And our approach has been, what kind of peg we are paying, and we have always been comfortable to pay between 1 to 1.2 times peg. Because if I'm looking for a 25-30% growth story, it is not likely to be available to me at 12 times P or 15 times P. So I think you have to see valuation in the context of potential growth and potential opportunity size. And very often people make a mistake that if it is 15p, it is cheap. But if it is cheap at 15p, despite growth, there may be some reason, right? So I think always you have to see valuation in the context of the growth and the ROEs and business model company generates. And that is how we always evaluate. We don't get carried away by the broader noise. And you've seen over the years how our stock picks have been, despite, we've never believed only in the consensus calls. We've taken against the consensus calls. But once we are convinced about the potential growth and the risk reward of the story, then we do take the sizable bets.
Vikas, how are you playing consumption at this point? What's the best way to play consumption? Because we've seen some numbers come through and some of those numbers look very, very good. The likes of a Britannia, the likes of an Eicher Motors, the likes of a Titan, three diversified, spaces within consumption. It's looking good.
And it is linked to, like I said, that linked to the macro environment, which we saw last couple of years, last 12 to 18 months. And that all has a reflection. With that lag, it happens. So we've been very, in last, to 2019 to 2024, we never played consumption because we could not get our arms around on the valuation given the growth. But in last 6-8 months, we have meaningfully, kind of played that out, especially in the consumer discretionary space. Even automobiles we take as a part of the consumption, and that we have a fairly large exposure. We also have, and a bit of a derivative of that you can look at within the manufacturing space, as well as the, let's say auto and ancillaries are also part of a play of the automobiles, right? So in some sense, you look at companies, what are the growth drivers? You don't necessarily play only the first order impact. You can play also second order impact, where you understand the risk reward given the valuations. Fact of the matter is that most of the consumer FMCG companies are also fairly priced, and still, while one quarter might be good, but you can't meaningfully predict a high double-digit volume growth for them. So, growth is still, despite all those things, is not a very high growth, sustainable growth. And if you have to pay that kind of P, then you have to be careful. So we have to look at, should we play first order, second order, and we assess overall situation. And we have played some consumer discretionary, we have played automobiles, we have played some second order derivatives of that.
Vikas, at the start of this conversation, you suggested that Nifty will likely give better returns, or 2026 will be better with regard to Indian markets versus 2025. Where's your tilt towards? Mid-small caps, or is it the large caps? Because Nifty has given a very decent return even in 2025. So if we are to better that, then would you continue to stick to the large caps? Would you shift your tilt to mid and small? And if you're shifting your tilt to mid and small, would the best play be in certain sectors and pockets? Could you give us those?
Like I said, while we've been always balanced in terms of, we have different products. We have a product which is more mid and small cap focused, with a flexi cap product where we are definitely right now almost 60% mid and small cap. So we are definitely sort of focusing on. But again, it's not by design. It's more like our bottom of stock picking idea where we are finding more comfort. And I do believe that mid and small cap this year will do well. Some of the spaces which could stand out in this year would be chemicals. I think you are seeing a big macro tailwind. Of course, you will keep validating. You can't really take it for granted, but it looks like that after almost a year and a half or 2 years of pain, we are likely to see, due to changes in the policy in China and some of the policies in India, that sector could do well. Auto components look pretty decent. The building materials product looks very decent. So consumer, discretionary space, you can find lots of ideas. Within banking and financial services, you are finding we've been largely tilted in last 12 months towards NBFCs, and that has played out, and we think that's more likely to play out. So again, you look at different segments, which we have. Mid-cap IT is something which companies which are more evolving or aligned towards AI-related enabled companies. There we are kind of playing out more. So again, you kind of look at different niche spaces where you have a little bit more confidence around the growth, and you play that out.
Quite interesting. Vikas, great to have you today on the show. Thanks for your time.
Always chatting with you.
Okay, let me